GrowCFO is where finance leaders grow together. Join thousands of like-minded professionals using GrowCFO to access the combined knowledge and experience of the finance leader community. You can join us today, growcfo.net. Hello, and welcome to the GrowCFO Show. I'm your host, Kevin Appleby, and today I've got Janelle Gorman with me, who is CFO at York IE. Janelle, welcome to the GrowCFO Show.
Thanks so much for having me. I'm happy to be here.
Janelle, tell us something about you.
Sure. Personally or professionally?
Oh, start with the personal stuff. That's bound to be more interesting.
Sure. Yeah, I live in New Hampshire in the US. I am a mom of two. And so all of my hobbies tend to be those that are shared with a 7 and 10-year-old, mostly gymnastics these days.
And the professional bit. Now, you've become CFO with a 7 and 10-year-old. That is quite a journey. Now, tell us about that journey. How did you get to be CFO at York IE?
Yeah, a lot of hard work and probably a lot of luck too, if I'm being honest. So my background is a CPA background. So got an accounting degree and just went into public accounting with it. I did the years there that you've got to do. And then one of my clients was a really interesting subscription model company. It was internet infrastructure as a service. So IaaS, not the typical SaaS, but we know we can put in as on just about anything these days. And so I joined that company. That's where I fell in love with high growth subscription model, the as a service thing, tech life. And I'm sure we'll dig into it, but tons of lessons learned there just being part of a high growth environment. And I haven't stopped since. So I love the high growth model, working with early stage startups and seeing what we can help them become with the background of accounting, and then strategic finance kind of worked its way in because you got to get strategic when you're growing that fast. So through that company, I kind of met the right people, was involved in the right strategic transactions. And that's where the luck kind of plays in along with that hard work to then be able to be CFO here, trying to keep up with it all with a 7 and 10-year-old. Why not?
So how long have you been in the role?
I've been at York IE for almost 4 years. But the co-founders and managing partners of York IE were all folks that were also at that high growth company with me. It was a company called Dyn, DYN, and that exited by sale to Oracle in 2017. So we all stuck around there for a bit, and then these folks kind of spun out their own thing here with York IE. So I've been here for a few years, but it feels like much longer because I met them all in 2012.
Yeah. So were you CFO in that previous company, or is this the first CFO role?
I did one company in between Oracle and York IE while I waited for them to kind of need a CFO. It's not usually a role that you hire. And so the company in between was my first CFO gig. That was a technical manufacturing company in the defense and aerospace industry. So very much not software as a service, but a really great role. Also with high growth, they exited to a sale to private equity. So that was my first CFO role. It would have been fun to be CFO at Dyn, but I was just accounting manager up through kind of controller position there.
Yeah. So did you get involved in the goings on around that exit very much, or was that happening?
Oh, yeah. Yeah, I sure did. We were a small team, especially on the finance side. So once they signed the letter of intent, they kind of brought a few people in under an NDA and the cover of secrecy. So we could kind of work nights and weekends to get through that due diligence process, close the deal. And then it took about a year to transition everything over after we did. So that first couple of months under kind of that secret process of the pre-diligence, that was exciting and stressful and pretty cool to be a part of.
Yeah. So moving into that first CFO role and then going through another exit, at least you had some experience.
Oh, for sure. Yeah, that was really great. And not something that I necessarily saw coming. It was a single owner of that company. When I started, she said, I really don't know if I'll ever sell this thing. It might be what I do forever. And I don't know if it's my own itch for high growth or what's next or big transactions, but we found a buyer that kind of made her an offer she couldn't refuse. And I was like, I know how to do this actually. Like, let's get this done. And we actually did it in 6 weeks. It was a really fast close. And she's
Wow,
sales.
6 weeks.
Yeah, it was pretty wild and small team. So I was the only one really working on that from a business perspective. Everybody else was kind of left out of it. They wanted to keep it really kind of secretive for that. So it was a much smaller group there. Nights and weekends again, nothing I wasn't familiar with, but a really great exit that set the owner up for a really fabulous retirement in Florida. and set the private equity company up with a really great company that they can pull together and really find value at scale for the clients they serve. So a win-win all around.
Yeah. But late nights and weekends with what must have been fairly small children at that stage. That can't have been easy personally.
Yeah, they were little. No, it wasn't. But actually, I have a funny picture of myself and my older daughter. I think she was 3 at the time. And I set her up. I was at my dining room table with all of my laptop and everything. And I set her up with just a keyboard. It wasn't plugged into anything. And so I have a picture of us kind of working together on diligence. So I like to say she was part of the deal.
Oh, I love that. Love
Yeah.
that. Yeah. But thinking about that deal, doing in 6 weeks, what tips would you be giving to other CFOs being plunged into that situation? What gets a deal like that done in 6 weeks?
Yeah, I think that's a really great question. And it probably can be different depending on the transaction. So I think asking that question to the key stakeholders is probably your first step. So what I did was I got on with our points of contact at the private equity firm and I spent a lot of time with our attorneys. Those were kind of my key stakeholders. Now, in other transactions, you might have bankers, you might have different investors that are coming to the table, you might have a board of directors to work with. So kind of identify your key stakeholders first and then ask very clearly what's most important to them. What do they need to see in order to move the deal forward? And so for that particular deal in 6 weeks, I think it was able to move so fast because it was a single owner and it was a leadership team. There were only 2 of us, really. Like I had kind of my manufacturing operational leader, and then I was kind of the business leader. So with a smaller group and fewer stakeholders in the transaction, it was easier to move faster. But really what I did was with the attorney say, okay, you just give me a list of 100 things to do. What should I work on first? What things are going to take the longest? And it kind of combed through to say, okay, don't just start at the top and work your way down. But one of the things we had to do there was to get consent from significant customers. So I thought, well, that's going to probably take a while because I don't have control over the customer's consent process. Let me start there and get them working so that anything that was going to take the longest, I started first. So understanding what was important to the key stakeholders and then identifying the things that would take the longest, starting that first, that kind of helped us to move things along quickly.
So, deal done, and you join York IE. Tell me about York IE. What's the business all about?
Yeah, it's a really cool model and it's different. And I'm excited to tell people about it because if anybody looks us up, they think maybe we're one thing or another, but it's really a pretty cool picture altogether. So we are an early stage investment firm. We've deployed $60 million to about 60 companies, our average check size being about $1 million. And we deploy on a rolling process. So every year we're deploying more capital, calling more capital and deploying more capital. But the thing that's really exciting about York IE is that we're also a service firm to support the founders and companies that we're investing in or that are just in a high growth startup space to begin with. So I mentioned earlier in our conversation that the folks that were co-founders and managing partners of York IE were from Dine. So our work at Dine really taught us how to manage a high growth startup company, especially in the as a service space. And so the idea for York IE was, hey, let's deploy capital into these companies that we really believe in and that we know a lot about. But let's also be differentiated to actually provide help and support that these founders and companies need to be successful, which is a bit of a double win. We're doing what we know and love, but we're also kind of de risking our investment a little bit. And where we're super early stage, of course, that's a very risky place to be. So if we can be helpful and maybe swing some of the weight in the favor of these founders and early stage companies for them to kind of make it out the other side and be successful, then we're really excited to do that. So that idea has really taken off over time. York AE was founded in 2019. So just over 5 years or so, we're now about 250 employees globally. We have over 200 people in India and then folks in the US that are working with these clients, not just our portfolio company, just by a function of numbers. About 15% of the companies we work with are also in portfolio. But we're working with them on things like go to market, so websites, SEO, digital marketing. We're working with them on product development, so building out MVPs, accelerating roadmap, UI, UX, just all sorts of engineering dev. And then my favorite, because I'm biased, we're helping people on G&A, most specifically in finance. So we're helping folks with financial forecasting, due diligence, pitch decks, capital planning, board reporting, KPI analysis. And that's growing actually next year to also include bookkeeping. And who knows from there? So York IE is really an investment and advisory firm that is founder focused, founder first, and kind of a high growth accelerator with extra hands on deck to see how many companies we can help make huge.
Yeah. So I'm guessing that a check size of around $1 million, then we're talking venture capital. We're a long way before Series A.
Yeah.
Yeah.
Generally speaking, although the title of rounds can be a little funky sometimes.
Oh, absolutely. Yeah. Yeah. So I would be guessing that a lot of the companies you're potentially investing in are pre-revenue.
Yeah, they tend to be pre-revenue, maybe in the hundreds of thousands of revenue. It depends kind of on where they are. We've written some checks too, and you can kind of probably appreciate this from COVID for companies that have reinvented themselves or
Yeah.
pivoted. So maybe they've been around for a bit, but where they think is going to accelerate them into the next stage isn't necessarily what's gotten them to this point.
Yeah. Right. So how do you decide on what looks like a good company to invest in?
Yeah, great question. There's a lot of elements that we're going to look at, and I don't know that they're always equally weighted, but the key things that we're going to look at are going to be the founder and the founding team. You'll hear a lot, especially at this early stage, that investors aren't necessarily investing in a company, they're investing in a founder.
Yeah.
Because you're pre-revenue, a lot of what we're kind of betting on is the idea and the conviction that somebody's going to have to bring that idea to fruition. And startup, they say like your 0 to 1 million in revenue is some of the most difficult dollars you'll ever earn. And so really that founding team has to have the conviction, motivation, tenacity to like really stay in it. So having a good connection with the founding team is really critical. We believe that kind of the first thing that a company needs to have for scalable success is product market fit. So we're going to look at kind of the product and the market as in part of that diligence process. So what really problem are you addressing? Is it resonating with the market that you want to be selling to? Are you addressing a real need? And does your product really solve for the need that the market is seeing? Sometimes founders or entrepreneurs can get an idea and then be really obsessed with building the product without the mind for, is this what the market wants? So they might say, well, this is great. This is everything I could dream it would be. But what you have to make sure is that it's everything the market could dream it would be and that they're actually going to buy. And so having those kind of two assessments of what is the market demanding? What is the product offering? And is that really resonating as a good fit? That's one of the critical pieces that we're looking for, which, as you can imagine, is really hard to figure out. But when you've got it, it's solid gold.
Absolutely. So you're sitting as CFO in York. Does that mean you're purely doing an internal CFO role, or are you spending time working with those clients as well?
Yeah. If I could just have one of the elements of my job, I might have a little more time in the day or be able to sleep a little bit more than I do. But the answer is both. And actually, add one more thing. So I'm CFO for the fund, as you might think of it traditionally. So I'm interacting with investment partners, calling capital, deploying capital. We're doing K1s, tax returns, financial statement audits. We're doing investor statements. And then, of course, when we have an exit, distributions, calculations of gains, all that fun stuff. And then I'm CFO for York AE internally. So as a company with 250 employees globally, we have all the CFO and
Yeah.
finance operations works that you can imagine. And then I also am, for now, serving as executive sponsor and leader for the finance module. So I have some clients, but the good news that I'm thrilled to share is that I have a team I'll be building up starting actually this month, which is really exciting and really rolling out into full force into Q1. So that finance service offering can really take shape of its own with a full-time dedicated leader exclusively to that service. And we're going to start building out our team in India because we think that having full-time offshore resources is a great way to drive scalability and capacity without driving up significant costs. So more help is on the way for what we're going to be doing in our finance offering.
Why India?
So we got kind of lucky. We had a single consultant in India that was helping us build out our own software as a service platinum, which is called York IE Fuel. Recommend you check it out. It's very cool. And this was a couple years ago, back in 2019, 2020. And he was so talented that we're like, you got to do more. Like, help us build more things, help us build different platforms or different features and functions. Some of our portfolio clients needed help with development. And we're like, hey, we actually found a really great developer. Why don't you work with him? He got busy enough that we said, why don't you open your own consulting business and we'll send you more clients. We can work on this together. That got to be about 10 people. They got busy enough that we said, why don't we acquire that consulting practice? And so now they've grown over 200 people and they're all full-time Yorkay employees since we acquired that practice a couple of years ago. So we found a person, and that person happened to live in India, and he's built out a really phenomenal team
Mm.
there.
So it was definitely a choice of a person rather than choice of a country.
That's
Yeah,
right.
yeah, yeah. Now, I'm looking at your website, and I'm seeing on the website, Tech Woman Invest.
Yeah.
Tell me more about that.
Yeah, I love that. This is one of the things when I get more time in the day, I'm going to go back and spend more time on. But a couple of years ago, we're kind of looking around the room. We were having a in-person investor meeting, and we were just like, "There's not enough women in here. Like, women invest too. Why is this room full of so many men?" So we really kind of went on a campaign to try to even it out and see if we could get more females investing with us. And there are a few, of course, like we take any meeting that we can find. But what we were finding is that a lot of the potential investors we were talking to, the female investors, were just not quite there. Our minimums maybe were a little bit too high, or the commitment was a little bit too long, or whatever it may be. They just kind of all seemed to say, like, hey, this is really interesting to me, but I can't quite jump in as deep as I would need to in order to do this. And so we thought, well, if the minimum commit is 500,000 for the fund, then why don't we pull some of these women we've been talking to into an LLC so they can meet that minimum together and invest at a place that's maybe more comfortable for them so that we can get their time and talent and resources into the group, because we like all of our investment partners to be active in the portfolio as advisors, as experts, whatever the case may be. So we formed Tech Women Invest LLC as a group of women interested in investing at a lower dollar amount that then could come into the vehicle to meet the minimum as a group. No, we don't just want to stop there, right? We got them in the room, but now we need to kind of know their expertise and nurture community among them. And so I've got to be better at this. If any tech women investors are listening, they're going to be like, you haven't had a meeting in a while, but we like to get together as a group. We also share opportunities with those women, whether it be for advisor engagements or investment opportunities or just intros of smart people getting together just to have more of a diverse group in the room. And so that's been really cool. The women involved in that group are pretty awesome. So I'm honored to work with them.
Love the idea. Female entrepreneurs, though, a specific female investment group, are you doing anything to direct that money towards female founders?
Yeah, great question. So our investment thesis is really business oriented. So it's industry agnostic, B2B SaaS technology. We love to invest with female founders, but we don't carve off any specific dollars or have any particular allocations to them with this group. And the idea being the thesis is going to be really business based, but the more diverse we can create the group, the more diverse we're going to have for leads for our investments. And then hopefully the more female founders we invest in without having to have any specific rules over diversity of dollars allocated. So we have some really great female founders in the portfolio that are doing tremendous things at some of our fastest growing companies. So thrilled to have that. And I think having just more females investing just brings that network a little bit wider. So we have more opportunities with more females as we grow.
That is brilliant to hear about. I'm reflecting back to a previous podcast with David B. Horn, who wrote a book, Funded Female Founders. And this was all about the inequality of funds going towards female teams versus male teams. And David setting in firstly to do the research and find out more about why that was the case. And then David subsequently gone on to help launch a fund here in the UK, specifically to help female founders, which is great news. David was talking about a bias, particularly at sort of private equity stage, that the number of business of proposals put forward by female teams and being accepted was much less than those being put forward by male teams.
Yeah.
And the real need to do something about that. The
Yeah.
subconscious biases there, just
Yeah, and
accept.
just being aware of it helps anyone to kind of acknowledge when they might be falling in a bias trap or they might not really be reaching as far as they should be in order to make sure they're getting proposals from people of all sorts of backgrounds. So step one is kind of knowing about it. Through Tech Women Invest, I did connect with a lot of women who are saying they're interested in this, but they want to make sure they're only investing with female founders. And so our vehicle might not be the right fit for that, but our group is still able to connect investors with, okay, well, if that's really what you're looking for, then I have other groups I can connect with that only invest in female founders or otherwise underrepresented founders. Or I hear similar things too with environmental technology or whatever the niche may be. The larger our network, the more we can connect people with the investments that they might be most interested in. And if it's not ours, that's totally fine, but we're still able to make some connections, which will still potentially get more dollars to female founders, which I think is important.
It's absolutely important. So your target company to invest in is fast growing B2B SaaS.
Yes.
Yes. So tell me a little bit more about the typical challenges those companies have got.
Yeah. My opinion here will be skewed toward finance because that's the world I live in.
Fine.
It's
And that's
just
what our audience lives in as well. So
yeah,
yeah.
perfect. It kind of has to do, I think, with scarcity. At that stage, there's an abundance of ideas, opportunity, need. It takes a lot to grow. You need time, resources, technology, funds, people, advisors, and it's just scarce. You're going to have a smaller team than you want to have. You're probably going to have a lower budget than you want to have. And so, kind of dealing with how you invest in growth while preserving resources in times of scarcity is a really difficult balance. I think we saw the market do some really funky things in a few years ago where people would just say growth at all costs and I can burn as much money as I need to because I'll just go raise more as long as my ARR is growing. And I don't think that was probably ever a good idea, but especially now where fundraising is harder to come by, there's fewer dollars at play. You really can afford to take risks like that. So growth has to be really pragmatic. And usually the inverse function of speed and risk is going to come into play, right? So you can't grow as fast as you want to, or you're capable of because you just can't invest as much as you might want to. You have to play kind of the long game and make sure that you have a decent cash runway in front of you. So, and kind of same for time, right? Because you can't go out and hire a huge team. So if you only have, say, 10 people and that's what you can afford to maintain for your payroll, well, those 10 people have to be very purposeful on what they're working on, what they're spending their time on, how they're really finding product market fit, what the product roadmap looks like, what clients they're talking to. There's no time to waste on talking to someone that's not your ideal customer, your ICP. And so most of the time that I spend is trying to figure out, okay, here's all the things we want. Here's the resources we have. How do we properly allocate this to just keep moving in the right direction? And I think all that you can do is in these days when you might be short on resources, but heavy on ambition is just pick the thing to do right now that will get you towards the next step towards your goals.
Yeah. And I guess the ultimate success for you with one of the companies you've invested in is for that company to move on and find new investors because they've got to the next stage.
Yeah.
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 So
Well,
if
ideally, we could create an additional funds, and I think that this could be in our future where we can invest at the next stage as well and continue on with them, right? Like if we can be big enough, we're a startup too, so we're a startup investing in startups. So there's plenty of stuff that we as York AE want to do to be able to write the next check and follow them into Series A and B and wherever they may go, or whatever it may be. So that's part of our own growth journey, I suppose, at York AE.
yeah. So you must get involved with a lot of organizations that need a good fundraising strategy towards the end of their journey with you. So
Yes.
yeah.
Yeah, absolutely.
So what does a good fundraising strategy look like, Janelle?
Well, I think that step one is really making sure that the strategy is set. So I think it's funny, whether you're talking to a bank or an investor, nobody wants to give money to somebody who really needs it, right? Like, and so having your strategy of purposefully knowing how you're managing your company pragmatically, where you want to be going and what's the investment that you need in order to get there. Having that clarity, even from the outset, is really critical before you start to raise. We see some companies that can fall into a trap of like, oh my gosh, the bills are piling up and things are slowing down. And if I don't fundraise, then bad things happen, right? Like I'll have to do layoffs or I'll have to slow growth or I'll have to shut down even potentially. That's a bad time to be fundraising when you're desperate for the funds. So starting early and really being purposeful on your strategy for when are you going to fundraise? How are the funds going to be used? When you still have a bit of cash runway, that's really the best time to be planning your fundraising strategy. And then you need to have kind of a well thought out pitch of what are these funds going to be used for? And it shouldn't be like, oh, because we ran out of money and we need more, right? Like that's not a good strategy. So, kind of having your initial strategy of like, I'm looking to raise this much money in order to do these particular things that will bring my company to the next level and unlock XYZ opportunity. Remember, I said in the beginning, like, as we're investing, we're looking for investment in founders and the founding team, and we're looking for product market fit and how your plans to deploy the capital that we give you will accelerate your company into growth. So, demonstrating in your fundraising strategy that here's the team I either have or I'm going to be investing in. Here's the product that I have. Here's the market that I have. Here's how that fits together. And here's how I'm going to strengthen that fit. That's kind of all the recipe to provide investors conviction that you'll have acceleration and growth in the future. So, fundraising really sounds very quantitative and like we're fundraising because we need money. Duh, it's a simple answer. But actually, your pitch shouldn't be that. It should really be very strategy based with qualitative financial planning to support that strategy.
So, clear lesson there is if you're desperate for the money, you've probably left it too late to do the fundraise.
It will be harder for sure. Now, I'm not saying it's impossible because sometimes then on the reverse side, you'll say, well, why would I dilute my equity ownership and dilute my whole cap table to take on money if I don't need it? That's silly. So it's somewhere in between,
Yeah.
right?
Yeah. But I know that during 2023, 24, I've spoken to a lot of people in the investment world that have told me that funds have become scarce. Is that still the case, or are you seeing a stronger market out there?
We are seeing signs of movement. So I don't think really like the floodgates have opened just yet, but we're starting to hear a lot more conversations, especially around M&A. Been a lot of pent up demand for M&A and activities like that. And I think once you start to see some dollars move, it'll kind of have a flywheel effect of, okay, well, if M&As start happening, then folks that have money tied up in illiquid assets might get a payout, which means then they're more likely to go ahead and reinvest. So then fundraising can start back up again. But where everything was kind of stuck coming out of 2022 and that bubble kind of burst, a lot of people went, "Ooh, let's wait and see." And they kinda held back and kept their money on the sidelines to see what the outcome is gonna be. I think people now and then that trickles down, right? If nobody's money is moving, then my money certainly won't be moving, and so it has that impact of everybody kinda holding and waiting to see. And then the liquidity just kinda dries up because there aren't any exits for these people that might have continued to invest. And so we're hearing now a lot of conversations start to be happening about M&A. People saying, hey, I think I might have some liquidity coming down the pipe. I'd like to start learning about investments to see where I might deploy capital as it becomes available. So I think in 2025, hopefully this comment ages well, but I think we're really going to start to see funds move a lot more in terms of M&A and then investing, maybe even IPO, right? The whole thing kind of moves together. I'm just really curious to see how fast it happens. Is a little bit of a trickle as people start to get more comfortable? Or does it kind of pick up in that same flywheel effect where people held their dollars because no dollars were moving? Do we start to see that too of like, oh, this is moving, so that can move, and it kind of comes together really fast? I think the pace of it will be interesting to see how that plays out.
Indeed, it will, but it's nice to know we're seeing some light at the end of the tunnel.
We are. And it's kind of the question I lead with too as I talk to investors or other VC funds or lawyers that are in this space. I'm kind of asking them what they're hearing too, because more chatter, I think, will be a leading indicator of more activity.
So, Janelle, you've covered a really interesting journey of your own, moving up, taking on CFO roles, finding this love of high growth SaaS B2B, we've talked about York IE and that really interesting mix of all of those fractional services along with venture capital investment. So there's one question that I'd ask. Now, of those fractional services, which of them do you think most of those startups need most? What is it that's classically missing in this sort of startup that you
Yeah.
find time and time again you've got to plug the gap?
Well, from behaviors of what people are most excited to talk to us about, it's product development, especially with a kind of this introduction of AI. And I was talking to somebody who said it's funny on the West Coast, if you don't have AI in your business, no one wants to talk to you. And on the East Coast, if you have AI in your business, people are nervous about you. That's in the US, of course. And so it's how people are responding to AI is interesting, but certainly for one degree or the other, it's playing a huge part in all sorts of startup businesses, even some that their idea for the company itself is based on AI. And so I think with that curiosity comes a lot of need for security, for additional development. It's a little bit of a race for some of these companies to get off the ground with this new technology that's available. They're eager to incorporate it so no one gets left behind. And I kind of mentioned that product market fit is incredibly important to have any kind of scalable success. And then a lot of that comes with the product, right? And so
Yeah.
knowing what the market wants and then being able to build it. So we're seeing a lot of activity on the development side. I would argue, though, that, and I've said this forever, finance tends to come last in people's minds, especially when times are good, when growth is high and cash is plentiful and sales are closing and everything's fine. It's very easy to kind of fall back and run the business on a cash basis. Check the bank, and as long as there's still six figures, then we're fine. Keep going. And that's a really dangerous place to be. Finance tends to get the most attention once things break or something's gone wrong. And so I'm really passionate about the finance offering. It might never be as big as websites or digital marketing or product development, but it's really critical to always be running a pragmatic, healthy business. Even when you're flush with cash and you're flush with sales and everything's going well, to really know your metrics, know your KPIs, and really be pruning a fine-tuned, well-run business. One, just because it's best practice, and if you wanna make the most money you can, then run it clean and be efficient. But two, because if we've learned anything in these last few years, it's that we never know what's around the corner. And so you always wanna be prepared for unexpected hard times or an unexpected M&A offer that they wanna start due diligence tomorrow and close in 6 weeks, or unexpected for good or bad. Running a clean business operation and clean finances will give you optionality, which is critical.
Mm. And I guess a lot of the companies that you're talking to are too small initially to have their CFO themselves, so they're very reliant on that advice coming from you.
Yeah, absolutely. And they should be, right? Like, I don't wanna go and scare everybody then and think that they have to go hire a really expensive CFO finance resource, but it's just important to right size the effort to your size of the company. And so that could be outsource finances, outsource CFO. It could be just an advisor that maybe you even pay in equity. We've seen that, or maybe some that are willing to go unpaid for a while. But including it as part of your business strategy to some degree and having someone in the room that has an eye for that and can guide you in the right direction is really important.
No, that is fascinating. So, for you yourself, what's next for you? What's around the corner?
Gosh.
Where are we going to see you in 5 years' time?
Yeah, I'm excited about the growth that we're seeing at York IE. So there's a lot of ideas that we have here. Like I said, York IE was started in 2019. So we're just getting started. And 2019 is a tricky time, like right before COVID happened,
Oh,
right?
yes,
The
absolutely.
market burn. So it's been helping startups in these times is a stressful thing to do, but I think we're really onto something and we're seeing a lot of really great growth. And it's also reflected in our portfolio and the companies that we help. So I think hopefully in 5 years, if you come back and talk to me, we're deploying more capital. We have more investment partners. Tech Women Invest is huge. We have a female fund specifically, or maybe we're in more advisory areas. So not just the three that I mentioned, but maybe we get into talent or who knows. But I think the company can have a really big impact on B2B and just high growth technology companies in general. So I will be here working as hard as I can to help make as big of an impact as I can and hopefully with a bigger team.
And that's a nice thing about a fast growing business. It
Yeah.
can grow at the rate you want to grow. personally.
Yeah.
Yeah,
Yeah.
absolutely. So I'm looking forward in 5 years' time, if I'm still around doing the GrowCFO show, to come back and talk to you and see what's happened.
I would love that.
Janelle Gorman, thank you for being this week's guest on the GrowCFO show.
Thanks so much, Kevin.